This is the story of a debt that was never supposed to exist. $1.7 trillion owed by 43 million Americans. It touches nurses, teachers, veterans, parents who co-signed. More debt than every credit card in the country combined. Nobody robbed a bank to create this. It was built one well-meaning law at a time. To understand the trap, you have to meet the people who built it: bankers, regulators, and the borrowers caught between them. It starts, like a lot of American promises, with a president who believed education was the great equalizer. But 6 decades later, that promise looks like something else entirely: a machine that keeps running long after graduation. We're going to follow the money, from a 1965 classroom to a 2026 collections court. Along the way, you'll meet the lenders who got rich on a loan they could never lose money on. The regulators who tried too late to rein it in. And the borrowers who did everything right and still can't get free. This isn't a story about bad people, it's a story about bad incentives. And it starts with the best of intentions in the fall of 1965. President Lyndon Johnson called it part of his Great Society, a war on poverty fought partly with diplomas. The Higher Education Act of 1960 colleges, it guaranteed student loan. The idea was simple. Private banks would lend the money, the federal government would guarantee it against default. If a student couldn't pay, the bank still got paid. Washington covered the risk. For banks, it was almost too good to pass up, a loan you could not lose money on. For students, it meant a state school, or even a private one, was suddenly within reach. Enrollment climbed. Campuses grew. For a generation, it looked like the promise was working. But a guarantee against risk changes behavior for lenders and eventually for the schools themselves. If the money was always going to arrive, why not lend more of it? In 1972, Congress created a new institution to buy up these loans and keep the money moving. Its name would become one of the most recognized in American finance: Sallie Mae. It was built to make loans more available. It would end up making them a business. For 30 years, Sallie Mae operated as a government-sponsored enterprise, public mission, private profit. Then in fully privatized, no more government strings, just the guarantee and the upside. By then, other lenders had noticed the same thing. Student debt could not be discharged in bankruptcy. That single rule, tightened by Congress over the years, made student loans nearly impossible to escape. A loan with a federal guarantee and a borrower who legally cannot walk away. For a lender, it's close to risk-free. So lenders expanded further, second market. One of the biggest players was still Sallie Mae, writing private loans to students at schools with the weakest odds of graduating them. Internal state investigations later found default rates on some of those loans as high as 90%. The lender didn't need the student to succeed. The guarantee and the bankruptcy rule meant it barely mattered. This is the part regulators would spend the next 2 decades trying to catch up to. Because while the loans kept flowing, so did the tuition bills on the other end. Easy credit and rising prices turned out to be two halves of the same machine. From the 1980s through the 2000s, tuition rose faster than almost anything else in the economy. Wages for most workers did not keep pace. The gap between the two had to be filled with borrowing. The federal government now originates roughly 9 out of every 10 student loans made in America. Federal spending on student loans grew by more than 300% in just 3 decades. For-profit colleges saw an op federal loan money and very few questions asked. Recruiters were sometimes paid, in effect, by how many students they signed, not by how many graduated. Some of these schools left students with tens of thousands in debt, and a credential employers didn't recognize. By 2010, total student debt had already crossed $1 trillion, passing credit cards for the first time. Congress and regulators started asking harder questions, but the loans already outstanding weren't going anywhere. The Consumer Financial Protection Bureau, created after the 2008 crash, one servicer, above all, became the focus of that scrutiny, a company called Navient. Spun off from Sallie Mae in 2014, Navient served millions of federal borrowers directly. Investigators from dozens of states began building a case that Navient had broken the law. The allegations steering struggling borrowers toward forbearance. But let interest keep piling on top of what borrowers already owed. One state's attorney general said it plainly. The company had made a business out of borrowers' confusion. In 2017, the federal government sued Navient directly, alongside multiple state lawsuits already underway. Years of litigation followed, borrower by borrower, state by state. In 2022, 39 states reached a settlement, cancelling $1.7 billion in private loan debt. Roughly 66,000 borrowers, mostly from loans made between 2.2 and 2.10, had their balances erased. The Consumer Financial Protection Bureau went further, banning Navient from federal loan servicing entirely. A $120 million penalty followed, along with direct restitution to harmed borrowers. It was one of the largest student loan enforcement actions in American history, and it changed almost nothing about the debt itself. Because the money owed by everyone else, the $1.7 trillion of it, was still due. Today, more than 5 million borrowers are in default on their federal student loans. 1 in 10 federal loan dollars is delinquent. Money the system already assumes it may never see again. Every attempt at broad forgiveness has run into the same wall: courts, Congress, and each other. Meanwhile, collections have resumed and the economy has less cushion to absorb the shock than it once did. For borrowers, the math is brutally simple: pay, defer, or default, and every option has a cost. For the institutions that built this machine, the incentives that created it mostly still exist. The guarantee is still there. The bankruptcy rule is still there. The tuition bills keep arriving. What's changed is scale. A program built for a few $billion now moves 1.7 trillion. Reform proposals arrive every year, capping interest, tying payments to income, holding schools accountable for outcomes. Most stall. The ones that pass rarely touch the debt already on the books. The borrowers are still waiting, not for sympathy, but for a system that matches the promise it made them. The Higher Education Act promised that any student could afford college. 60 years later, the country is still paying for how that promise was kept.